Now, Credit Suisse shares have fallen after it warned it will book a loss of up to 1.6 billion Swiss francs for the fourth quarter. Now, it comes as the embattled Swiss lender undergoes another sweeping overhaul. Now, for more on all of this, let's bring Bloomberg's Charlie Wells. So, Charlie, good morning. You're keeping us smarter on what's happening at Credit Suisse. I mean, asset outflows were huge, and it feels like every week there's a problem at Credit Suisse. Like, how do they get out of the spiral?
Yeah, so Francine, this was supposed to be a day of turnaround for Credit Suisse, but it's instead, in just a few hours, turned into a day of turmoil. So shareholders are voting in Zurich today on a plan to raise $4 billion in capital. This is a part of that turnaround plan. But of course, what we are seeing in this announcement from Credit Suisse is bad news, not just for its investment banking unit, which we sort of predicted, we've known about for a long time, but also loss projections and outflows from wealth and asset management in the end of the third quarter, totaling to about $90 billion, which analysts from JP Morgan have just said is concerning.
So what does that mean for how shareholders will vote at the extraordinary general meeting today?
This is tricky. So proxy advisors have been telling shareholders that they should vote in favor of this change, of this capital raise of $4 billion. That involves issuing new shares to the likes of Saudi National Bank, which would take a 10% stake with those new shares, but also giving a rights offering to existing shareholders. The issue, of course, is dilution. So those shareholders who are unhappy today because of the dramatic decline in the price of that share also would see their shares diluted because of these new issuances.
But they probably don't have a choice, because we're talking, I mean, otherwise, if they don't have that capital, what do? Can they even survive?
That is so on point. They are stuck between what I would say is a boulder and a hard place, because, they would have a dilution of potentially 34% on earnings per share, but if they do not approve this measure, that dilution would be about 40%. So they really have few options here.
I mean, what happens to Credit Suisse going forward? I know that there was, a lot of concerns about solvency, which the chief executive really pushed back against.
Right.
But where do you see this bank being in the next 12 months?
Well, look, the plan was to really focus on private banking, to focus on wealth. But when you see that $90 billion approximate outflow at the end of the third quarter, you just think this is a real challenge of trust. And banking at the end of the day is about trusting someone to be a custodian of your money. And what we're seeing from these client outflows is that trust is in short supply at Credit Suisse right now.
Charlie, do we know where these outflows are going? Is there another bank that's benefiting?
I think that will come to light in the days ahead. Of course, there are other banks in Switzerland. This is just Switzerland's second largest lender. We know that, Credit Suisse had kind of set itself apart by being the bank that did not need to take a government bailout during the financial crisis. Other banks in that country did, but that may have created an atmosphere inside the bank of risk-taking, of failure to check on compliance in the way that other banks that did struggle perhaps more in the financial crisis did not.